Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project. I'm your host, Duke Ong with Tri-City Equity Group. Today we have Alex Shandrovsky on the show. Alex is a 1031 expert with Madison 1031. With me is my co-host, Vince Gethings.
Hey, Duke. Pretty excited today. Alex is definitely an expert at 1031s. He's they call them Qualified Intermediaries with Madison. Outstanding show. You're definitely going to want to get your pen and paper ready. If you're ever interested in what 1031s are, especially what TICs are, if you ever heard of tenants in common or TICs, and we're always just not sure what those vehicles were or how to use them. Alex definitely goes into some great detail on ways to use those vehicles to achieve certain outcomes for setting up either syndications or TICs to achieve the goal we want as sponsors, or as an LP, ways to maybe defer some taxes on some capital gains that you are maybe expecting as you exit an investment. So you're going to want to stay tuned for this episode. A lot of great nuggets.
Alex is a Silicon Valley seasoned entrepreneur. Starting with a $3,000 loan, he built a multi-million-dollar catering business serving leading tech companies like Google, Airbnb, and Facebook. He has been featured in numerous publications, including Newsweek and San Francisco Chronicle. He studied digital marketing at Dartmouth University Business School. As a senior business development representative for Madison 1031 Exchange, Alex has the privilege of building multi-generational wealth for driven real estate investors. Alex, welcome to the show.
I couldn't have written that better than myself. That was amazing. Thanks, Doc. I really appreciate it.
All right. So let's go back to your kosher shrimp days. Can you take a few minutes and go over your experience in Silicon Valley?
Yeah, it was a little wild, actually. So I had a large catering company, and we happened to be one of the largest producers of sushi in the Bay Area. I was running a sushi factory. We were literally had it was a fish warehouse which imported fish daily, called Royal Hawaiian Seafood. That was the name of our place. So here we go. We brought it back to Hawaii, and we had this space right inside the fish factory where we would basically get fresh fish, and produce sushi right there and then, and that was a great product. The problem is that I ran also a kosher company, so we were not using any shellfish, right? So we were kind of limited, and people really need their ebi, so we needed to provide that. And I had a side project where I was trying to build out a kosher halal slaughterhouse in Sonoma. It was a little bit of a wild project, which brought me to this world of cellular agriculture. Right now, people talk a lot about it. Some companies called Memphis Meats are very popular. Just is another really popular company, for a lot of investors investing in companies like Beyond Meat, which is not cellular agriculture, but it's plant-based alternatives using technology as well. So I had a chance to meet entrepreneurs in that space who were trying to create this alternative proteins, and I was lucky enough to start selling them and producing them through wild underground parties of kosher shrimp. So we had a lot of fun. I got featured in a few articles in news. So it was a great experience running that company. The food industry, I think, just similar like to a property management, it's a really hands-on industry. It's basically you're there in the trenches. It's not a blue collar type of work. It's really hands-on. So I learned a lot from that experience, and I had also the privilege of hiring a lot of people from prisons as well. So I spent a lot of time in maximum security prisons, teaching about entrepreneurship and hiring people for my company. So it was a very fun company. I really enjoyed it. And but it also led me to this other opportunity with Madison, which I'm excited to share with you guys today, unless we're going to talk about kosher shrimp, and that's where we're going to go.
Oh, no, yeah. Please share what Madison 1031 does and how investors can lower their capital gains taxes.
Yeah, sure. Absolutely. So the first thing you do is you eat shrimp. No, the first thing you essentially, let's kind of look a little bit back, take a step back. As a small business owner, you kind of transition from this place of being, an employee who is working for a salary to an individual who's trying to create assets. What properties and in real estate is interesting is that you're essentially creating assets for yourself, where you're creating multiple streams of income, and that's a very exciting way of life because you're out of the matrix, as one of my friends Jerome Myers says. You're out of the matrix at that point. And as a real estate investor who is successful, what you'll find is as your property is appreciating value, you have this partner alongside. Whenever you invest, he's there by your side always, whether you like it or not, and that's the government. Mm-hmm. He is there with you. He loves you. He doesn't love you. He's always there no matter what. And then when you're ready to sell that property, he says, look, we've been partners all this time, and now I need you to pay capital gains tax on whatever your property appreciated. And that between federal, state, local, that could be more than 33%. Right? So here I am. I invested so much of my energy into building this asset. It's appreciating value. It's now time to basically sell it. And the government comes and takes 33%. Well, where we come in as a qualified intermediary, as Madison 1031, is we're able to leverage a tax code which has been in the books for over 100 years called 1031, tax code 1031, where we allow a person who facilitated the ability to reinvest the proceeds of the sale into an exchange property and defer capital gains. So in one word is, you want to stay in the market, you want to avoid paying capital gains tax, you have properties you want to purchase, you use a 1031 exchange to be able to do that and reinvest that money towards the future.
So can you give us a quick explanation of how 1031 works and what would motivate an investor to use that kind of exchange?
Yeah, absolutely. So very simple, right? So let's see what motivates an investor. We are seeing a lot of a great exodus that's taking place. Right? We're seeing exodus that's taking place from places like California. We're seeing an exodus that's taking place from places like New York. We're seeing states which in the past maybe have been more friendly towards landowners and property owners, increase taxes, put rent control. And at a certain point, an owner says, maybe this is really not the place that I want to own this property in, and I want to have properties in other places. So one of the encouraging factors is they're going to use the 1031 exchange to move to a different location. Or, for example, an individual owns, one of my favorite examples in San Francisco, they may own a studio in downtown. They've been renting out an Airbnb. And they say, look, I want to get out of San Francisco because, look, COVID-19 just happened. San Francisco is essentially relying on tech. Tech companies are thinking, wait a second, why am I having all these employees in this extremely expensive location? Maybe I should spread them out. Look, maybe San Francisco is not the best place for us to be. So the guy says, I want to get out of San Francisco so that he can sell that studio for $1 million. And then reinvest that in a multifamily 20 units somewhere in Montana. So some people are looking to go into a different asset class. Let me leave residential to go into mobile homes. Let me leave single family to go into multifamily. That's another reason why people are going to do that. And another one, which is kind of popular as well, as people in their 60s, they're 65, they've been hustling. They're tired of their houses flooding. They're tired. They are tired of dealing with that insurance. And they're saying, enough is enough. I don't want to deal with the toilets. I don't want to deal with the tenants. I just want to have a peace of mind. I want to go to Florida. Maybe it's not Florida. Maybe it's in Spain. I heard they're giving away free towns in Italy. Maybe I want to go to Italy. I just want to have residual income. And what they're doing is they're selling their investment property and then reinvesting into a triple net lease property where they're essentially just a passive, or it might be a syndicate potentially, where they're basically passively getting a check every single week, every single month. They're living off that money, and that's their retirement money, right? And they do that, and they still avoid the capital gains tax, right? So they're able to get that paycheck, which gives them that mailbox money. They get to retire in Florida or in some other state that doesn't charge state tax, and they live a good life until they pass away, and the property steps up in basis, and you actually do not have to pay capital gains tax. So that's another reason why people are using 1031 exchange. And then we can talk about the exact way it's done, but those are some of the popular methods of why people would do it.
So at Tri-City Equity Group, one of our divisions is multifamily syndication, and we often come across investors that have 1031 funds. So we wanted to bring a 1031 investor into a syndication. How would that work, and how would we get started?
Yes. Okay, so this is we deal with this a lot. So let's kind of break down the 1031 process, and we're going to first talk about the challenge of a challenge of getting 1031 money for syndicators, and then we can talk about, okay, well, this is how we can go and deal with that challenge. So essentially, a 1031 exchange is the idea that you're exchanging real property for real property. Okay, so you have a property which is your investment property. You got that studio in San Francisco, and you're going to go into Honolulu and get that beautiful apartment right across Duck's window, which I would love to live in, right? So and that's again exchange of real property for real property. Now, when you're going into a syndicate, you're not actually buying property, and that's a challenge. What you're actually buying typically is an ownership in an LLC of the syndicate. So that's not an exchange of like-kind property, not doing real property for real property, and therefore a 1031 might not work in that fashion. Okay? So that's the challenge, right? So we were pretty clear with that challenge. Awesome, perfect. Plus, I keep looking at that house across behind you, Duck, and I'm like thinking, gosh, I want to exchange into that. So I have that challenge. So the way that syndicators take in money, and we just spoke to a syndicator actually 2 days ago. He brought in $1 million of 1031 exchange money into a $5 million purchase. And what happens is what he did is he created a tenant common structure where he had the LLC control 75% of the property, and then he divided out an interest in the actual property for the other, say 20%, right? So divided 4/5 and 1/5, and then that investor purchased that part. So he actually bought direct interest in the property. So the LLC holds the 4/5, and then the syndicate holds 4/5, and the tenant common holds the 1/5. Now, there are reasons why syndicators don't like to do that, because typically a syndicator, the way that they are structuring their deals is they're getting paid for finding the deal, finding the investors. They're usually getting paid some sort of management fee, and at the end of it, their earnings from the deal might not be proportionate to the amount of money they put in. Right? It's not an exchange for capital investment, but really more like sweat equity of the GP. Well, that wouldn't happen in tenant common, right? And that's why syndicators are concerned about doing a 1031 unless the 1031 can really bring enough money to make it worthwhile, right? And there are structures of how that syndicator what he did, and again, it was aggressive, but that's what he did. It was that he became also the manager of that tenant in common. He charged the fee, and he was also still had the voting rights across the entire project. Right? So there are alternatives. There's options on how to do that. But there's two things that are really important to understand. Is if you want to go into a syndicate, if you're bringing in $50,000, no, it's just not going to happen. There's other structures of how you could get bring into, but that's at $50,000, and no syndicator will take a $50,000 typically 1031 exchange because it's a hassle for them. But if it's a significant amount of money and you want to work with a syndicate, typically a syndicator will work with you. Doug, one more thing that I would mention as well is that we spoke to another syndicator 2 weeks ago, and he owned. I'm not going to reveal names because he was a pretty popular, famous guy. So I'm not giving you the description. I'm not giving you the age. I'm not going to give you the eye color. It's all going to be private. But what I will say, is the following. I said to him, you currently have a syndicate and you own 300 units, and he's like, no, I own 313 units. It's like, if you wanted me to know the very exact, like 313 doors, not 300. And he has a 5-year hold plan. Right, that was his 5-year hold plan, and he's hoping that the syndicate and the LPs are going to continue on to the next property with him, and when they're going to reinvest and sell the property in 5 years' time. So I asked, in say 3 years' time, I asked him, when are you going to have a conversation with your LPs? What do you mean? I'm selling in 2-3 years. I said, you have to talk now with them, because that's a big problem syndicators make. Is that you have certain people who are not going to want to go on the ride with you. They're going to want to cash out, and you don't want to know that last minute, because you need to set up the tenant common. You need to drop them from the LLC in order to facilitate the 1031 for the LPs who want to continue alongside of you, or the 1031 can explode. So it's on both sides really important, right? If you're a syndicator who wants to take 1031 money, well, you have to have a tenant common structure. And if you're a syndicator who wants to continue for the ride with your LPs without having to pay out the capital gains tax and then reinvest again together with the same people, well, you need to have that conversation about the long-term plan. Are they going to do 1031 together with you? And if not, you need to slowly work on getting them through a tenant common out of the LLC. Boom.
Can you explain that?
That was a mic drop right here.
Could you explain that tenant common structure from the seller side, like as an owner of syndicate LLC structure into the tenant common, and how the returns would be handled?
Yeah, okay. So essentially, a tenant common would be, you'd be breaking down the property into pieces. That's what it would be. And they would own a piece of that property. So 100% property, they would own 10% of the property, and they would get, at the end of the day, if your NOI, right, if your return on that investment is $100, they will get $10, right? That could not be changed. Now, again, you can come in as a manager of their tenant common, but typically, whatever money they put in, that's a percentage they're going to get out.
Okay, so can you explain that being a manager of the tenant common from a syndicator perspective?
Yeah. So what I would say is, I'll say it like this: is that my preference is that that each syndicator should speak to their CPA or the QI individually offline, because there's different ways of how aggressive you want to be. That's why I don't want to give a blanket statement on how it should be structured, because there's a degree of aggressiveness of how aggressive you want to be in pursuing that methodology. But in essence, by being the manager of the tenant common that the 1031 owner has, you have the ability to vote on his behalf, potentially, and get a fee for managing it. So even though so you can make up the challenge of having them actually own part of the property rather than LLC through the fee. But again, there's different ways of how people can be aggressive in that approach. We would say is this point is, if you are in New York City, if you are in New York or California, you want to look at this very, very closely, because the state franchise board is quite aggressive on challenging 1031s, right? So you want to have those fees set up. If you are investing in places which are have no state tax, well, that would be an easier argument to make. So that's another thing about how aggressive your strategy should be.
Got it. So what are some common problems that GPs might encounter with having a 1031 investor on board?
Look, the biggest common problem you're going to have is, if you're not going to be aggressive, is your ability to sell the property fully. You might be able to only sell your part of the property, and then that other investor is going to still own his ownership because he owns that part of the property. You don't own it. And that could be very scary for a GP. Like, imagine, I'm going to sell a property, but I'm only going to sell 90% interest in the property. Well, that's a little funky, because you have some investor out there saying, well, I don't want to deal with this guy. I don't know who he is, right? So that creates a concern. Again, unless you set up a structure where you can vote on behalf of that person, there's an agreement in place. And there are structures like that. Again, those should be discussed with your QI or with your CPA directly when setting it up. That's one of the challenges.
So, what role does Madison 1031 play, or any other qualified intermediary?
Yeah, sure. So the role of the QI is really crucial, and in order to facilitate 1031, you need to have the QI involved before the sale. Right, that's really important. You need to be able to have the QI already involved and in your documents before the sale is completed, because as soon as you get receipt of sale and get cash in hand, you have to pay capital gains tax. We get calls all the time of people calling saying, I'm excited about this 1031 thing. I heard about you guys in the podcast. Alex, Michael, Brady, you guys are awesome. I'm ready to do 1031. I asked, okay, so when are you closing? Last week. It's like, I'm sorry. Like, well, it's like you missed the what'd you call it? The ball dropped. When do people kiss in New Year's Eve? Is that when the ball
Times
drops?
Square. Yeah.
Like the ball dropped. It's like you're 5 minutes later. It's already 2021. You're done. You can't kiss. Done. You're finished. All right. So that's what I would say about the 1031 exchange, right? Is that the QI has to be put in place before, because what the QI does is essentially he takes the proceeds of the sale of your property, and he purchases on your behalf. He's your agent in purchasing the exchange property, and then he gives the deed of the property to the buyer. So it's only an exchange of deed rather than of money, and that's the key point here. No money has been. You did not receive money, right? No money has hit your account. A deed was brought into your possession. So the qualified intermediary does that. He is that linchpin, which is the middleman between you transferring you selling your property, and then purchasing another property and getting the deed.
Got it. Okay, so let's shift gears a bit. Can you explain how a Delaware Statutory Trust works in the context of syndications?
Okay, so a DST. DSTs are really good vehicles, right? And they're interesting vehicles, which I just spoke to a DST, like just earlier today. Somebody from a DST reached out to me. They're a good option for a few reasons, okay? So they're essentially, a challenge with a 1031 exchange is the following, is that you have 45 days to identify a property. So you sell your property today, boom, you sold your property, and then you got 45 days to identify alternative properties. So you have $1 million property, you sold that beautiful investment penthouse in Honolulu, and maybe that was $1 million, and now you have $1 million you want to exchange. Well, that $1 million you want to exchange, you typically pick 3 properties of any value that you're going to exchange, and then once those, after 45 days, you have an opportunity to close on the properties. So you might have 3 properties, each $1 million, and you're going to try to close on one of the 3. You close it, and the 1031 is completed. You've deferred capital gains tax. So you have 45 days to identify a property. That's tough, especially in a seller's market. That's really tough. I had someone reach out to me yesterday saying, I have $300 million that I want to invest over next year. That's like a pretty significant number. And then they told me the rate of return they're looking. 80% occupancy. I'm looking for cash and cash, 8 to 12%, RRR 30%, like really wild expectations, right? Everybody's looking for a deal. Look, in 45 days to find a really great deal might be tough, right? Especially in times when you have a market that's pretty hot. So a Delaware Statutory Trust is basically, it's almost kind of like a fallback safe option. You're buying an interest, right, in a variety of products that can actually be spread across the several products that can take 1031 money. And usually those products are managed by somebody else, right? The challenge is those products they only typically take accredited investors, typically. So DSTs, you don't have to be an accredited investor, which is you'd have to have 2 years of consecutive $200,000 of income, over $1 million of net worth. So for certain people, it's just not an option, right? There are other vehicles that they could take less, or they don't take accredited investors, right? And there's other vehicles but for Delaware Statutory Trust, it's a really great option if you're an accredited investor and you want to have a safe bet with maybe a 3 to 5% return that you don't have to basically worry about that somebody else is going to manage. It's usually going to be a triple net lease. But that's a good option. But the returns, because it's a safe option, the returns going to be smaller. Usually, a lot of those triple net leases were in retail. So what can I tell you? Even a safe option might be challenging at times.
Especially in these times.
Very interesting times, yes.
Yeah. So could you use a multifamily syndication in a DST?
It's a great question. Multifamily syndication and DST. That's a really great question. I'm trying to think about that. The terminology there. DST is a vehicle. Are you saying can a multifamily syndicator invest into a DST?
Yeah, like use the DST as a tool to defer capital gains.
I don't see a reason why not. I don't see a reason why not. Yeah, I don't think so. I'll double check that question. It's a really good question. I don't see a reason why you would not be able to. But again, for a lot of syndications, people are looking for bigger returns. They're looking for aggressive 8 to 12%. Right? So they're not going to be happy to invest their money into a DST. They might say, I'd rather cash out.
Switching gears again, your background is in digital marketing. So what marketing advice would you give a commercial real estate firm looking to capture attention?
Yeah, look, that's a really, really great question. Look, I think you guys are doing an excellent job, right? I think podcasts right now are something that's really important for people, especially when you're trying to build a following, especially when a podcast can. What I found is interestingly enough is that, and this is several of the podcasts that we've been on, is fascinating, is that their podcasts are for a highly localized area. So when you can combine a podcast with a meetup together, that's a powerful punch. Right? So you have that international body of wisdom, and then you bring that body of wisdom into your local meetup is really powerful. So we've had that a few times where we appeared onto, you appear onto on the podcast, and then they'll say, come into our monthly meetup. And then you continue the conversation like that. So, in terms of digital marketing, what I would say is that it's a funnel towards a personal relationship. I don't think that personal meetup is going to go away. Right? We've had one syndicator, I can't reveal their name, we're looking to use ClickFunnels to straight up basically use a messaging of we're going to use Russell Brunson's ClickFunnel of if you're this type of investor and you're looking for this type of returns, you fill out this form and then we send you this ebook, and this ebook is going to drive you to this and drive it down. But when we're talking about investments of significant amount of money, I think there has to be that in-person connection. That's why most successful syndicators have local meetups. That's just the case.
Plus, also, it doesn't. It helps very, very clearly write the lines for SEC compliance of pre-existing relationship. If we're just internet, email pen pals, that might not be a substantial relationship for SEC compliance. Where we have this meetup. They've attended 3 or 4 meetups. We have over 10 hours of face-to-face communication. It's really hard to combat that. If SEC ever comes knocking of how we know these people. So
I've heard a lot of challenges in terms of if basically people are trying to use social media to create clear offers of financial investment.
Yep.
I don't know.
Conditioning the market.
Yeah, conditioning the market and advertising when you're not what is it, a C?
506.
You didn't have an exemption. Yeah.
Yeah, you don't have the exemption. So, all right. Well, I think I'm up next for questions. Duke didn't really leave me much to talk about. You guys kind of nailed everything, but I got something. So,
Vince, we can just talk about the 4-hour work week right there in the back.
Yeah. Hey, nope. Wrong hand.
That's what we have for tribes of Titans. I love that. You basically are. You got everything going on there. We could just talk about you.
Yeah, I'm not that exciting.
Oh, please.
But so a couple notes I took just to crystal clear on what a 1031 can be used for and can't be used for. That the like kind definition, because I think a lot of people just are unsure of what they can transition into and what they cannot transition into.
Yeah. So let's make one very simple. Vince, are you in your own home?
Yes.
Is this your primary residence?
Well, yes, it is.
In theory, right? So you can't do a 1031 with that where you're living right now, assuming that you own it. So that's one big one, right? You cannot. It has to be an investment property for an investment property. So, one thing to realize is that if it's your primary home, right? Actually, there are better exemptions. The 121 exemption is a better exemption than the 1031, right? Most likely, right? You can combine both, but anyone who owns a primary home, they can basically, wipe out almost $500,000 worth of capital gains, assuming you're married, right? So,
and that's the you've lived in it the last 5 years.
Yes.
Right. Yeah.
So, and we'll talk about this in one sec, but so that's one. The second thing is we see is really popular. We have people reaching out to us. It's like it's that guy who's watched something on Netflix or on YouTube, and then he got he gets continually he's the guy who watched all the Tony Robbins stuff and Guy Kawasaki and then of course Grant Cardone, and then next thing you know he's just getting hit up with advertisement and flippings. Flip. You know that guy, the 25-year-old who's I'm gonna just flip the world. Flipping does not work for 1031 exchange. You cannot purchase a property, refurbish it, sell it for profit, and then 3 months later do a 1031 exchange. No, that is the intent of not investment, but intent of sale. Mm-hmm. Cannot do that as well. So that wouldn't be a good
time limit, or
I'm sorry?
Is that based off of a time limit, the intent on investment versus intent in sale? Is it like 366 days? It's now an investment, or
so typically there's different ways of how aggressive you want to be on that. Typically you was advised is 2 tax years is the minimum. So December 31st. And then in 2 years, January 1st could be okay. Station, because that's still 2 tax years. But less than that, if they see, because what they're gonna be asking you is when did you purchase a property and when did you sell the property. That's one of the things that you're gonna have to, and that's the first thing they're gonna be looking for. If that could be a problem.
Okay.
Yeah.
Great. So what is I'll ask this in kind of 2 ways. So as a sponsor, if an investor comes to me or a potential investor and they say, I have 1031 funds, or I will have 1031 funds soon because I'm looking to exit this other investment, what should be the first thing I should be asking them and the first thing I should be doing as a sponsor of someone coming to me and they're asking these these questions? They're looking to place 1031 funds in my things. Like what should be the first thought that comes to my mind, or the first action I should take?
Yes, it's a really, really great question. I mean, the first question you want to ask is how much they're bringing to the table, because again, you're relinquishing control, right? Part of the beautiful thing about being the GP typically is that you want to be able to make the decisions, right? You want to consult, but you want to make the decisions. So if they're bringing a very small amount of money, well, that's going to be a challenge. The second thing is you're going to see is, can they, if you are purchasing the property, the timing has to be pretty tight, right? Because we're talking about he has to sell his property identify that property with your property within 45 days. The timing there is tight. So the question is going to be is can that money get freed up fast enough, right?
And then what sale after that? It's like 180 days or something.
180 days, exactly. Which could be worked out. That's not as much of a challenge, right? That's
the
not
45 days, the hard one.
But at the 45 days, right? So again, the continuous things we're seeing with syndicators, yes, there are people bringing 1031 money into syndications for sure, 100%. And there's even more. There's people who are 1031 out of a syndicate. I think that's really where you want to be thinking about.
Okay.
Because think about it, we're all in sales. Isn't it easier for you to get a repeat sale than a new customer? That's what when I talk about syndicators and 1031, I'm almost not as worried about you bringing the 1031 in as I'm keeping your syndication together for the next deal. Because as the GP, that's what you want. You want that group to go into the next deal with you.
So how does that work? I guess it didn't click for me yet. If we're in a syndication and my limited partners don't own the real estate, right? They own shares in a company that's owns real estate or real estate backed company. How can they do a 1031 if they're just doing, like, they don't actually own the physical real estate? So that's still an option for syndicators to syndicate out of.
For sure, because the limited partnership, the LLC owns it. So the LLC is going to own the next property as well.
Got it. So, and this is where you're talking about, like, if as a sponsor,
but if they don't want, that's a problem.
Yeah. So you have to have that conversation very early on, possibly years before you plan on exit of maybe put the vote or make sure it's in the operating agreement.
Because otherwise you need to either buy them out or you need to give them an out through a tenant common agreement so they can't cash out their piece and you continue to reinvest the 1031.
Okay. How far does that need any kind of seasoning period? Like, if I plan on selling next year, how soon should I start that conversation and get the legal paperwork done?
So what we typically say is, like, you want to do it at least a year in advance. Again, you could be very aggressive because if you do it right away, right? If you drop people from the LLC, so you can basically part of you can do 1031, and then part of you will cash out. Well, it looks like you're not doing the 1031 for the purpose of investment, and that's a problem. So again, you want to try to have these conversations in advance with people. And people are going to appreciate having that conversation. Now, things can change, obviously. People are going to say, look, I need cash out now. But if things are working correctly and you're doing a great job, they're going to want to continue with you. They're not going to want to go. Because again, think about it. They're going to cash out. They're going to give the government 35%. And they're going to again go back into a syndication. Does that make any sense?
Yeah, no. If you've done right by them, then I would think a lot of them would want to continue to let it ride, so to speak.
Yeah, that's probably what's going to happen, right?
Yep. So for I've heard you mention a couple times that it's kind of there's some complications of managing these things or setting them up, and there's some hurdles. Is there like ongoing maintenance that is required or ongoing service for people that are doing either tenants in common or 1031s, like past that point of sale? Is it like every year they have to do something, every quarter or anything like that?
Well, typically, from my understanding, is that the tenant in common will be responsible for that percentage of the expenses. Mm-hmm. Right? It is his 10%, right? So the way that you divvy up expenses is quite it will also have complexity. And again, this is something you want to bring your accountant into, and also have a conversation with QI. The point is, I think, for your listeners is what they need to come out is something very simple, because we want to simplify for them. Yes, a 1031 is an option for you to go into great syndicators, for sure. 2 is you need to realize about what level of control you want to have as an investor when you go into a syndicate. And 3 is think about, are you a lifetime investor? And if you are, again, a 1031 is going to be the way to go.
Yeah.
And I think that's, we need to explain to people this thing about real estate, which is quite unique, right? Is that if you continue doing 1031 exchanges until the point of death, what happens is you have that step up in basis, which actually not just defers capital gains tax, but it actually makes you not have to pay capital gains tax for your inheritors. And that's very attractive. You know, that's an amazing gift you can do for your futures, for your future.
Yeah, the what's his name? The wow, man, I can't think of his name. He's a Robert Kiyosaki advisor that wrote the book. Tom Wheelwright.
Tom Wheelwright, yeah.
Yeah. So his book, really good on that, on that estate planning side of it, was really good. So if you haven't read that book yet, listeners, those are the Tom Wheelwright books from the Robert Kiyosaki Rich Dad Advisor series. They're really good on that topic. So a lot of the buzz has been going on since I forget what is it the Jobs Act that instituted bonus depreciation. So as an investor or sponsor, how should we consider or put the decision on 1031 on one side of our option, and then a bonus depreciation on the other? Can they be done at the same time, or do you have to pick one and go with it? What are the pros and cons? Because I know the hot date right now is cost seg and bonus depreciation, at least for the next couple of years until it gets phased out, right? So
yes, it might not. Hopefully, that's
what are your comments on that?
We'll see what's going to be in the next election. That's a lot will be decided about what rules will be allowed, what's not allowed. So I'm not a cost seg expert. I'm part of Madison Title and Madison and Specs, which is Madison Specs is one of the largest, if not the largest, cost segregation company. You might have heard of Yona Weiss. I think you've had Yona Weiss.
Yeah, we had Yona on the show. So
Yona is like the expert. I'm not gonna, I want to stay in my lane, as they say. I'm married to my 1031 bride, and that's where I focus. He refers me his 1031 deals. I refer my cost seg to him. So I don't want to comment too far. What I will say is the following, right? Is that I will say an interesting case where a 1031 failing, right? So imagine you do a 1031 and it doesn't work out. Mm-hmm. So you have all of this capital gains now that you might have to pay. Right? So so you had appreciated property that was $400,000, and now you have to pay that capital gains tax. And what some people do in interesting ways, they do a cost segregation on another building, right? And to offset that capital gains tax.
So just kind of delayed a year in the future, essentially. So when you file the taxes for that next year, you'll be able to do that.
Well, absolutely. And then what they do is say 1031 that cost seg building. All right. So we see that there's this interesting interplay between cost seg and 1031. That cost seg can help those people who haven't gone through the 1031, and the 1031 can be there to help people who've gone the bonus depreciation, right? And are trying to avoid the massive capital gains tax and recapture that they have to pay, right? Yep. So they really work well together, and that's why our companies work really hand in hand in helping people, because we'll handle the title, we'll handle the cost seg, we'll handle the exchange, and we'll get the kosher shrimps. It's all gonna just come together all in one. Yeah. But the point here is that there is a relationship, and again, could rules change? For sure. I think that what we're seeing is there's a lot of people who are using these tools together. A lot of syndicators are using cost seg. And then because they've used up that depreciation quicker, and they're going to sell that property in 5 years, well, what are they going to do? They're going to do a 1031 exchange. Yeah, that's what they're going to do.
Yeah, that's awesome. You use a key tool there that is I use it every day, and you said it's a tool. And as sponsors or as entrepreneurs in general, having as many tools in your tool belt as possible is what you should be striving for. To give yourself as many options as possible, as creative as you can get, and just knowing about these things like 1031, when you can use 1031, when you can use like the bonus appreciation or cost seg. This is just another tool that gives you the flexibility, gives you multiple strategy, multiple exits, so you can do right by your investors, reach your strategies and your plan. So that was, I got one more. So are all intermediaries created equally? Now, what kind of due diligence should an investor or a sponsor do on the intermediary? Because I'm sure some are better than others.
Sure. So there are simple things like this. Is that people think that a qualified intermediary is like a doctor. Like, well, he must have gone to qualified school. I don't know what they do in that school. I don't know. They probably, make Legos. Yeah. I don't know. They go visit buildings, fix water holes. I don't know, but they do some qualified stuff. Well, a qualified intermediary just means that you're not disqualified, which is if an agent of the taxpayer cannot be a qualified intermediary, which is the lawyer. It cannot be the accountant. It can't be a close relative, right? I think it might be a mother-in-law might work, but I'm not sure. But that's also choppy. But it's really a very dysregulated industry, and that's challenging. So when you're doing your due diligence, you want to do some very important things. The first thing is you want to make sure that qualified intermediary has experience, right? So, for example, in Madison 1031, we've had helped defer billions of dollars of capital gains tax. We have certified exchange specialists with 3 of them in our offices, and this is kind of what we do, our bread and butter. We're not just talking about a local lawyer that's down the street and that kind of he just has a few 1031s. We're talking about billions of dollars that go through us on a yearly basis that we're trusted with. We want to make sure that there's a bond also. In case there's something that happens to the money, you want to make sure it's protected. You want to make sure that, nothing that the money is in escrow and it requires your signature to take that money out. That's really, really important as well, because unfortunately, there have been cases in the past where the QIs use those funds to invest in their risky investments and lost that money. So we want to make sure that we don't do that, right? Your money's protected, it's bonded, we cannot take it out unless you sign for it, and the company has a lot of weight behind it. We're talking about billions of dollars, it's safe. Those are the type of things that you want to make sure that you look at, because I say this very simply, you work so hard, man. You work so hard to get this investment, and this might be your first investment. You're 35, you're 40 years old, and you've been putting money aside, and you've been like, you look at that Starbucks as you walk by, and you say, gosh, I really want a Frappuccino, and you're thinking about, but maybe one day that passing that Frappuccino might allow me to invest with Duck and Vincent. So, gosh, I'll forget about the cappuccino. Well, you want to make sure that all that self-sacrifice, the self-control didn't go to waste by picking the wrong partners. And, just like picking the right syndicators, you want to make sure that you have the right QI that's right behind you.
Exactly. That was awesome. Awesome response. Yeah, absolutely. Back over to Duke.
All right. So, I guess to piggyback on that.
Duke, I just realized I was calling you Duck.
Oh, yeah, no worries.
The whole time. Does that happen a lot? Like people like Duck?
Yeah, I mean, it's whatever. I just picked one and went with it because, I'm in Hawaii, right? So Duke Kahanamoku is a famous surfer and waterman. So I figured Duke is easier because I'm in Hawaii, but it's actually not even the right pronunciation anyway. it's
oh my gosh. But. Well, I got to tell you, Duke, you just taught me a lesson.
Isn't it like an N? You said it like a, how do you say it in
Duke?
The correct way?
Duke.
Yeah.
It's like nasally because it's Vietnamese.
Yeah. Oh boy.
But anyway, so yeah, to piggyback on that 1031. Okay, so So if a syndicator wanted to 1031 into the next property with that whole group of investors, basically anybody who doesn't want to go on needs to be bought out. And then it's basically the same
bought out
process.
or doing 10 common.
Yeah.
But they need to leave. They need to leave the LLC.
So the process is similar to like an individual investor that's 1031 into another like kind property, right? Like it's just an LLC that's doing it versus an individual, right?
Exactly. I mean, that would be the LLC is basically has its own Social Security EIN number, right? It's an individual for the purposes of tax, right? So yeah.
Got it. Okay. All right. So for fire round questions, what is the best?
Nobody has done that before.
Not yet.
Gosh, I got a purple tie, a pink tie, and I got fake guns. Yes.
You're good.
Yeah. So what is the best business book that you recommend?
So I'm married. So actually, the best book I recommend is Getting the Love You Want, because it's been a great book for my marriage. Remember, if you get divorced, God forbid, it's a big partnership. That partnership is going to get dissolved. It's a big loss. So if for various reasons you do not want to go there, so I really encourage anyone who's married to really work, as much as they work on their business, to work on their marriage, because that partnership is important. So I see marriage as a business books as well. So that's Getting the Love You Want is a really great one. And another one in terms of business that I really, really, really enjoyed is I Never Split the Difference. That's a good one.
Yeah, absolutely.
People like that one. People like that one.
Book. No big deal.
Yeah. It's like, plus, what's the nice thing about that book is that you know that if you get hijacked, you'll be all right. You'll just negotiate your way out of it.
Yeah, just talk to him the late night FM DJ voice. Right? You're gonna let me go.
There are no drones here. That's it.
Or just call Chris Voss to negotiate for you.
Chris Voss.
I've taken this master course with Chris Voss. Let me just turn this on.
All right. So, what's your superpower?
My superpower, probably I wouldn't say I can read people's thoughts, but I can empathize and feel things very deeply. So when I'm in a room speaking with people, I can see details that most people can't see. So if there's 1,000 people I'm speaking to, I can usually feel things that other people can't feel. So it's a good one. I like that one.
That's like my wife.
Wow,
she calls herself a
empath.
Empath. I was like, you just cry a lot. I don't know.
Yeah, it's a borderline bipolar to empath to superpower. So you can go choose depending on the day, but it helps a lot when you're when you're negotiating or you're seeing things. It's powerful.
Yeah, absolutely. You can get to feel the pulse of the room very quickly.
And you have a book coming soon, Ascending, the Olin entrepreneurship book. Can you tell me more about that?
Oh, that, yeah. Well, I made a move. I guess I moved my family to a war zone. I moved to Israel. Our company is based in New York. We're one of the largest titled and cost seg, but I live remotely and I travel to the States. And I've immigrated many times. I was born in Russia. I was born in Moldova. I lived in Moscow. I lived in San Francisco. I moved to Israel. I'm like a constant immigrant, and I started reaching out to people. That's what I did. I started reaching out to people who are great entrepreneurs, from people who are investing in mobility, automated cars, to people who are building beer factories, and start interviewing them. Like what you're doing, with us, I wanted to learn practices of great entrepreneurs. So as an immigrant. Because I love this. I love this line from Hamilton. Hamilton is my favorite musical, and the line is, "Immigrants, we get the job done." Right. So it's definitely learning from immigrants and immigrant entrepreneurs. There's something very powerful you can do. So that's something that to look forward to. It's my side hustle project, which I hope to release in the year. It'll be fun.
Nice. Excited to look forward to that.
Yep. My pleasure.
All right. So as we wrap this up, do you have any requests for our audience, and how can people reach out to you?
Yeah, the best way to reach out to us is basically Alex Shandrovsky on LinkedIn. You can you can just Google my name. You'll see a lot of interesting things, a lot of stories about me. Or Alex and Madison 1031.com. In terms of my requests, my final request, my final dinner is very simple. If you have a property, if it's appreciating value, if you're a long-term investor, use us as a tool. Let us have a conversation. We help people all over the country. Even if we're not going to be your QI, we'll answer questions. If you're a syndicator and you want to bring people to your next deal or accept 1031 money, talk to us so we can help you form those agreements. But the main thing is, if there's anything that this time is teaching us, with strange, crazy time that we're living in right now, is that security is going to come from multiple sources, right? And then real estate could be a very powerful source of security for people. There's a lot of people who are looking at 401ks and saying, maybe that's not where I need to be keeping my money. Vincent's like, I
all that stuff that Robert Kiyosaki's been saying for 20 years is starting to, I think people are starting to wake up to it.
It's like, maybe I should have a piece of property. But if you're going to have that piece of property, you want to make sure you're working with great syndicators like Vince and Duck. Or
are you the sushi rabbi?
That used to be me.
That's the first thing that came up.
That is the first thing that comes up. Yeah, I used to be basically
sushi rabbi.
I was a monk for 6 years.
Wow.
I lived in almost like an ashram for 6 years, from 18 to 24. Yeah.
That's awesome.
Yeah, and now I'm a blood hungry entrepreneur.
Do you know how to brew the the Trappist beers from where is it? Is that Belgium?
Yeah.
It's so funny. What I can do is make really good herring. Exactly. You basically
herring stuff. Yeah.
You go to IKEA and you get that Swedish herring and you just make magic from it. That's it. In terms of brewing, I got my other friends. I'm like, I actually don't drink alcohol, at least not that much. I just not my path as much as again, I was in a very deeply spiritual cult-like order for 6 years, which I'm happy to talk to you another time. But I've learned a lot of discipline from that path, and but yeah, you can if you Google my name, you'll see a lot of my crazy stories there.
Yeah, I say sushi rabbi. First thing that popped up on Google.
That's what you're gonna see. That's what you're gonna see.
That's awesome.
That's it.
All right.
Well, yeah, you've been so generous with your time. I really appreciate you coming on the show.
My pleasure. And we're here for you. And again, thank you so much, my friends.
All right. Thanks, Alex.
Thanks, Ken.
Dude, that was an awesome show. Alex definitely delivered lots of information, lots of great knowledge on sushi and shrimp. But not for real. I took a whole page of notes just for our personal internal records. So definitely a lot of value. And I'm just going to go over just some of the bullet points I took away as an operator and things that I think LP should know. So the one for the operations, doing a cost segregation study with bonus depreciation on maybe a first sale. And then on the back end of that, do a 1031 on the second property. A great way that 1031s and cost segregation and bonus depreciation can mix together to achieve exponential growth over a very short amount of time. So that was one thing. And the next one for sponsors and potential investors. One of the first things that you should think about if you're going to go to a sponsor or a general partner with some possible 1031 funds is it's going to be first questions: how much do you have, and how long do you have to place it? Because if it's not enough, like Alex said, anything under 50 grand is probably not worth the hassle. It might be easier just to pay the tax man, go pay the government their cut, and cut your losses and go that way, and just take the cash. And then also, if you're already up against that 45-day clock and the sponsor doesn't have a deal under contract, it's going to be really hard to make that timeline. So always the first things is going to be how much do you have or should you be expecting from this 1031, and how long do you have to place it? Okay. Also, great knowledge on using TICs or tenants in common structures to creatively structure deals. I thought was genius. Big takeaway for me as a sponsor is if I was to take 1031 funding and have to structure a TIC, that I'm going to be the manager of that TIC of those funds. I'm not going to want to have where I own 80% of a deal and this other party owns 20% of the deal. And then if we have disagreements on how the property is managed or certain things like CapEx or projects on the property or how distributions are done, I'm not going to want to have to deal with that. So if I do take 1031 funds in a TIC, I'm going to want to have full rights of the managing partner on those funds. He also hit on an important point, and at the very, very basic level, like understand that for 1031 has to be an investment property. You cannot do this on your personal residence. There's tax advantages for personal capital gains on personal residence. This is a different code for 1031, so it can't be your personal residence. And then also it has to be like kind. You can't go from real estate into another investment asset. It has to be like kind. Other ones that I took here was that, and I asked this at the end, all qualified intermediaries or QIs are not created equally. There's firms like Madison they specialize in this. Like you say, they do billions of dollars in transactions a year. That's the quality and caliber of a firm you're going to want to go with, not necessarily the home office or the lawyer down the street that is kind of just an all around lawyer that has maybe done one or two of them in the past and kind of knows the basic structure, but it is definitely not a specialist. You're going to want to do your due diligence on your QIs just like you would with any other partner or vendor. Certain things. How many of these do you do a year? What kind of dollar amounts are you dealing with a year? Who are your vendors that they coordinate with? So that way you want to see that they have full streamlined systems and they run an efficient process and they actually do this stuff every day. They specialize in this field. Just like example, back to the lawyers, you're not going to want to get your estate planner to do your SEC paperwork if you're doing a syndication. There's people that specialize in that. If it costs more, it costs more. You're going to want it done right the first time. Other ones we talked about was using a DST, the Delaware was a statutory trust as a backup. If your 1031 fails and maybe you couldn't name a property in that 45 days or for whatever reason it fails, you can put it in a DST. Duke was also mentioning that there could be structures to where you do, instead of a syndication, you structure the entire deal as a DST, and that way you can take in 1031. So we're not an expert on that. And if you're interested, we can look that up on another call. Just reach out to us and we'll tackle that together. And then the last one I noted, and Alex said through his story of the importance of letting everyone know at least a year out for intentions of doing a 1031. If you're a sponsor, make sure it's in your operating agreement of what the protocol is going to be if a 1031 is an option for exit. And give multiple outs for your limited partners, because you don't want to get out to the point where you're 3-4 months out from transaction and now you're doing a webinar or a call saying you're going to do 1031 exchange into the next deal, because you might run into the issue where you said you don't want to assume that all your investors are going to be along for the ride. They might not want to. They might want to cash their chips, the cash chips in, or maybe they have a life event where they need those funds back for some kind of life event. So don't just assume that everyone's going to want to go for the ride and that everything's going to be fine. So you're going to want to have it outlined early in your business plan. Let your investors know. Have it in the operating agreement of what the protocol is for this, and let everyone know as soon as possible, at least a year out. He said, in order to get everything, all the legal paperwork done. If somebody needs to get bought out, they can get bought out or transition to a TIC for their stake in the deal, and that way, because you don't want to get up against the clock. With things like 1031, because like he said, it could explode on you if you don't do it right or soon enough. Duke?
All right. So if you're interested in connecting with us, go to tricityequity.com to learn more. To connect with like-minded investors, join our Facebook group, Honolulu Multifamily and more. Found value in this podcast, please subscribe and give us a rating and review on Apple Podcasts or Stitcher. If you know anyone who might resonate with today's podcast, please share the episode with them. See you next time.